Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that is absolutely crucial for every trader and investor out there, the stop-loss order. Think of it as your financial safety net, the seatbelt for your portfolio. It's designed to limit your potential losses on a trade, and using it correctly can be the difference between a small setback and a major financial headache. But here's the thing. Not all stop-loss orders are created equal. There are different types, each with its own strengths and specific use cases. Knowing which one to use and when is a skill that can seriously level up your trading game. So, in today's video, we're going to break down the three main types of stop-loss orders: the regular stop-loss, the trailing stop, and the stop-limit order. We'll explore how each one works, look at some real-world examples, and discuss the pros and cons so you can decide which tool is right for your strategy. By the end of this, you'll have a crystal clear understanding of how to protect your capital more effectively. Ready to become a smarter, safer trader? Let's get started. First up, let's talk about the OG, the classic, the one most people think of when they hear stop-loss. This is the regular stop-loss order, also known as a stop market order. Its job is simple and powerful: to sell a security when it reaches a certain price. Let's say you buy a stock at $50 per share. You've done your research, and you feel good about it, but you're also a prudent investor. You decide you're not willing to lose more than 10% on this trade. So, you set a regular stop-loss order at $45. What happens next? If the stock price drops and hits $45, your stop-loss order is triggered. At that exact moment, it instantly becomes a market order. This means your broker will sell your shares at the next available market price. Now, it's important to understand this nuance. While you set the trigger at $45, the actual sale price might be slightly different. In a fast-moving market, it could execute at $44.98 or even $44.95. This is called slippage. However, the key benefit is that your order is almost guaranteed to execute, getting you out of a losing position quickly before it gets worse. It's a straightforward, no-fuss way to define your maximum acceptable loss and stick to your plan, removing emotion from the exit decision. Now, let's move on to a more dynamic tool, the trailing stop order. This one is a real game changer, especially for trend followers. Unlike a regular stop-loss, which is set at a fixed price, a trailing stop is set at a certain percentage or dollar amount below the market price. And here's the magic. It automatically adjusts itself upwards as the stock price rises, but it never moves down. Think of it like a ratchet, clicking upwards with your profits, but holding firm if the price falls. Let's go back to our example. You buy a stock at $50. This time, you set a 10% trailing stop. Initially, your stop-loss level is at $45, just like before. But let's say the stock does well and climbs to $60. Your trailing stop automatically follows it up. A 10% trail means your new stop level is now at $54, which is 10% below $60. If the stock continues to rise to $70, your stop moves up to $63. You're locking in profits as you go. Now, if the stock suddenly turns and drops from its peak of $70, your stop at $63 remains fixed. As soon as the price hits $63, your order triggers and sells. The beauty of the trailing stop is that it protects your downside while giving your profitable trades room to run. It helps you ride a winning trend for as long as possible without giving back all your gains when the trend eventually reverses. So, the regular stop-loss is great for setting a hard floor, and the trailing stop is fantastic for capturing profits in an uptrend. But what if you're worried about slippage, especially in a volatile stock or a flash crash scenario? That's where our third type comes in, the stop-limit order. This one is a bit more complex, but it gives you an extra layer of control. A stop-limit order combines two prices, the stop price and the limit price. The stop price is the trigger, just like a regular stop loss. When the stock hits this price, it activates the order. However, instead of becoming a market order that sells at any price, it becomes a limit order. The limit price is the lowest price you are willing to accept for your shares. Let's try our example again. You buy at $50, you set a stop price at $45 and a limit price at $44.50. If the stock drops to $45, your order becomes active. Your broker will now try to sell your shares, but only if they can get a price of $44.50 or better. This is great because it protects you from significant slippage. You won't get sold out at, say, $42 in a sudden market panic, but there's a trade-off. What if the price gaps down, dropping from $45.10 straight to $44.40 without any trades in between? Your order would trigger at $45, but because the price is already below your limit of $44.50, your order won't execute. You'd still be holding the stock as it continues to fall. So, while a stop limit order gives you price control, it carries the risk that your order might not be filled at all, potentially leaving you exposed to even bigger losses if the price continues to drop. So, which one should you use? The answer really depends on your trading style, the specific security you're trading, and the current market conditions. The regular stop loss is a reliable, all-purpose tool. It's simple and effective for most situations, ensuring you get out of a trade when your thesis is proven wrong. It's the workhorse of risk management. The trailing stop is the go-to for trend followers and those looking to maximize gains on their winning positions. It automates the process of locking in profits, which is something many traders struggle with emotionally. If you've ever sold a winner too early only to watch it soar higher, the trailing stop might be your new best friend. Finally, the stop limit order is for the trader who prioritizes price precision over certainty of execution. It's best used in less volatile stocks where you're not as concerned about large, sudden price gaps. It can be particularly useful if you're retrading large positions and want to avoid the potential impact of significant slippage on your raw exit price. However, you must be aware of the risk that your order may not get filled in a fast-moving market. Each tool has its place in a well-rounded trading plan. Many successful traders actually use a combination of these orders depending on the specific trade setup and their goals for that position. To wrap it all up, understanding these different stop-loss types is a massive step towards becoming a more disciplined and protected trader. The regular stop-loss provides a simple, definite exit. The trailing stop allows you to ride trends and lock in profits automatically, and the stop limit order gives you control over your exit price at the risk of not being executed. The key takeaway is to never enter a trade without a plan for when you'll get out, both for a profit and for a loss. These orders are the tools that help you execute that plan flawlessly, removing fear and greed from the equation. I encourage you to log into your brokerage platform and see how to place each of these order types. Practice with small positions or even in a paper trading account until you feel completely comfortable with how they work. Knowledge is power, but applied knowledge is where the real results are. I hope this breakdown was helpful and gave you a clearer picture of how to use stop-loss orders to your advantage. If you found value in this video, please give it a thumbs up. It really helps the channel grow. And if you haven't already, hit that subscribe button and ring the bell so you don't miss our future content on trading and investing strategies. Thanks so much for watching, and I'll see you in the next video.